Position and money management. If you're taking this course as a standalone, congratulations on your first step. As we go through the course, I will explain other concepts from Master Trader Technical Strategies, just to reinforce some of the concepts of support, resistance, and trends, and so on, to get you somewhat up to speed. Of course, it's recommended to take the whole course, and once you've gone through this part of it, I believe that you will be ready to move on and gather all of the information together. If you're an old student from the past, you may be aware of the other concepts spoken about here, and that's great. This will help you, and I will try to reinforce more of that as we go along. What we're covering here is applicable to any tradable instrument. It doesn't matter if you're a stock trader, a forex trader, whether you're trading equity E-minis or currency E-minis for that matter, or whatever type of style that you are. Money management and position management has to be applied to whatever the instrument is that you're trading. The only difference is really the time frame that you're going to be looking at. So if you're a core trader using weekly and daily charts, you would apply the same concepts to those time frames. If you're a scalper and you're using 2-minute charts with for example, a 15-minute chart as your longer time frame bias, well, you would apply that to the management of the time frames that you're using. It's all the same. All the technical concepts are the same. Trends, support, resistance, retracements, and so on. And the money management, as I said, is the same. Of course, your position sizing will change based on the time frames that you're using and your strategy. Now, when you talk about money management, you can know all the technical strategies that there are like the back of your hand and recite them blindfolded. It really, without having the right money management rules and the position management rules, your odds of success are pretty small. And that's, the truth. Realize a 50% loss of your account requires 100% gain to break even. And you're starting with a smaller amount, and you have to double it just to get to where you are. So that really reinforces the necessity for rules and calculated risk, because it's a major part of being successful. And with the concepts that we're going to be covering here, if done properly, meaning following the rules, your gains can be exponentially increased with the same setups. Now, you have to approach this as a business. We say it's not a hobby, it's not for your entertainment, and I know some do that, especially the types that maybe they're successful in a prior business. They like to watch CNBC. They have some core positions, and of course they want to make money, but it does give them some thrills, or they're involved in the markets. This is not our focus. We are treating this as a business. We are looking to increase our income as income traders. We, as wealth traders, of course, we're looking to increase our wealth, and we have rules for this course is about money management and position management that revolve around all of the technical strategies that we use. Getting into a position, there are things that need to be known. How much room is available for the expected move? What is your target? Finding a setup, some type of a buy setup, which could be as simple as a breakout strategy. Is there room for it to move higher? Is the next reference point of resistance close at hand, which would suggest some type of a choppy, erratic type of movement, or it could be a breakout failure. And this is where the concept of the trading void comes in. And if you're taking this as a standalone course and you're not aware of what a void is, the definition is a gap which leaves a void, is a gap between the prior day and the current day. It's a rapid price movement in one direction where there's no support or resistance left behind, and then through a period of time going sideways that increases the size of the void. In other words, a bullish pattern, a head and shoulders type of a bottom, or a W bottom. So that bottom was preceded by a rapid move to the downside, or a long-term trending move to the downside, and those usually end by an accelerated move and then a period of chopping sideways and prices probing the bottom and coming back up again. And, that is what creates a void above, and the head and shoulders top is a bearish distribution pattern that creates a void below. Next, where does the stop have to be? We have to know where our stop loss is. As compelling as the pattern may be in the moment, we still have to define where our stop is going to be, where we admit we were wrong. It's not working out. And for whatever reason that might be, this is how we define a calculated loss. Have you looked at multiple time frames? That is a major key to successful trades. If you are a swing trader and there's a buy setup, however you're defining that, and we'll look at some examples of that, a buy setup could set up opposite a sell setup within a higher time frame. So the higher time frame could be in a downtrend and has just retraced up to an area of resistance and has started its way down, and during that period of moving lower on the daily time frame, it's very possible that it could have a pullback, which is beginning to turn back up again. So you need to look at multiple time frames to make sure that they're in alignment with your focus, whether that's a swing trader, whether that's a day trader, whatever your goal is. Using those time frames, you have to use multiple time frames. Market conditions. The broader markets will affect the majority of stocks. There are stocks, as we use the term, on your own page, be moving on their own. At times, gold stocks can move on their own. However, intermarket analysis, the direction of the dollar can affect gold. It can affect oil. If you're looking at a stock, you can look at what sector it's in and look at that sector ETF. So there are other things that can affect the direction of prices to be aware of. And I'm just going through this as a information for you to consider, which is not the focus of this course, but it is something to keep in mind. Does it meet your reward to risk parameters? Is there liquidity there? What is the spread between the bid and the ask? Is there volatility? Or an excessive amount of volatility? These are other considerations. You may get recommendations through a service like Master Trader's Advisory Service. You may be in a chat room where a moderator is calling to buy a particular stock. Does it make sense to you? You can't just follow. And even those with a good track record, you still have to be your own trader, meaning does it meet your trading plan? For day traders, what time it is? In the morning, there are reversal periods, 10 o'clock, 10:30, later in the day at 2:30 when traders are coming back from lunch, later in the day at 3:30. Positions are being initiated and or closed, so you need to be aware of that. Is it a quality pattern? As it always should be. Do you have a definition of what a quality pattern is? If you don't, you should. Now, when we talk about risk, how are you defining your risk? Many traders that come to the markets, especially years ago, everything was, I'll just buy $1,000. When, back in the day when there were what was coined at the time SOS bandits, when spreads were wider and there was what's called a small order execution system, novices made money. They bought 1,000 shares and prices would move up 50 cents because things moved in fractions at the time, and it wasn't uncommon for prices to have 25-cent spreads and move 50 cents rather quickly. Back at those times where the markets were less sophisticated in a sense and the technology wasn't, it was relatively easier to make money almost by mistake. And there was that 1,000 shares, whatever it was. That's certainly not a professional way to approach it. Are you going to risk $1,000 per trade? Well, that could be a good starting point. Can you afford to risk $1,000 per trade? It's a consideration. Will you risk 0.5% of your account per trade? Maybe that makes sense. Will you risk 0.25% per trade and 1% of your account? Now we're getting a little bit more sophisticated, and at least in the thought process of what the risk will be. Now you're risking that based on per day and based on master trader strategies. Now you're formulating a plan. Why define your risk, or what we would call R for short in this course? It means consistent losses. And not from the point of view of, just loss after loss. Of course, that is definitely not what I'm talking about. Whatever the losses are going to be, they are consistent and calculated and based on what that risk is per day, per trade, and so on. You're approaching each trade with a mindset of, well, this trade isn't going to wipe me out. And this is where, traders get on what I would call a white knuckle ride. What is a white knuckle ride? Get in your car, put the accelerator to the floor, and, once you're over 100 miles or so, you're grabbing that steering wheel and your knuckles are turning white. We're a state of fear of your life. And there are traders that are in fear, in a sense, of their life when they're trading, because they have no plan, especially for money management, and they are flirting with a disastrous situation. So of course they are operating in fear. So defining your risk, you've eliminated that. You're planning, and you can determine the amount of risk per trade, per day, or a week. And so psychology is a major part of money management. All trades are equal, and there's no stress. And if there is stress, and I will mention that I have worked with individuals that certainly could afford to lose per trade what their plan says. However, because of past time of having no plan, they've experienced large losses. They've taken that into the future, and they need to push things down to a risk amount that is meaningless. And at that point, commissions don't matter. It's all part of your long-term plan of being a professional, successful trader. So wherever you have to go to reach your comfort level, just do it. So a little more about defining that risk or R. New traders should spend at least a couple of weeks paper trading and then go to small share risk amount. I say you want to think long term. You say the market's not going anywhere, and your money might. There are lots of traders that never made it, only because they didn't have a money management plan, and they lost too much money. They certainly could have been successful, but they incurred losses to a point where they felt that they had to stop. Probably was the right thing. They would have lost all of their money. However, if they had a plan, and within that plan, I've taken a class. I know I have to become familiar with the strategies. I also have to become familiar with experiencing different types of market environments. I have to become familiar with my trading platform. It's very possible you might press the wrong button. Everybody does it at some point. So through doing that, your plan might be that to become familiar with these things, it might take you 6 months, and you may calculate that you're going to be doing X amount of trades per day if you're a day trader, or X amount of trades per week. And if I'm willing to risk X amount of money per day, per week, and so on, by calculating that out, I know that you are going to risk, let's say, $10,000 over the course of 6 months, or whatever the number is for you. With those sets of parameters, well, you know that at the end of 6 months, unless there's some disaster, and part of those disasters can be avoidable, like by not trading biotech stocks and holding them overnight, you know that the worst case scenario is that you're going to lose X amount of money over 6 months. That's going to be your estimated learning curve after getting that down. And after 6 months, if you've done that, you're going to have learned a lot. And if you're not making some consistent profits by then, well, you have to revisit your class and questioning the things that you're doing. Of course, you need to be keeping a trading journal so that you have some information there to see what you're doing right and what you're doing wrong. And by keeping that journal, you will certainly see that, no doubt whatsoever. Look at your losing trades and your winning trades. You will see what is consistent between them. Talk about this in a prior section of the class, where you track all of this in a platform called Microsoft OneNote. It's a great program, and it's probably on your computer already. So the size of your account. Experienced traders may use a percentage of their account size. So by progressing, by working your way up to the next level through successful trading, you can then increase that. Your time frames and strategies. Larger time frames may dictate a higher risk value, and that would be because you're doing fewer trades. As a swing trader, maybe you're only doing 2 trades a week as an estimate of what you might be doing. And through that, whatever your risk is per week, you can divide that by 2 trades, and you could put on a larger position size, of course, based on where your stop is going to be, which is going to be a bit larger for swing trades the majority of times. But we'll get into all of that. And through your trade analysis, keeping your trading journal, you'll find that certain strategies have higher odds of success. And keeping track of your trades and seeing how they're working, different strategies and management. So your risk, that's money. What is that going to be? How much are you going to risk on an individual trade? And that applies to your own situation, whether that's, like it says, $10, $50, $300, $1,000, and so on. We'll get further into this and look at that and how it's calculated. And this next slide these are the calculations that we're going to be doing. These are simple calculations. What is your stop loss? What's your entry price minus your stop price? What is your potential gain? Your entry price minus the target. What is your max dollar loss? The shares times your stop loss. Your share sizing. What is your dollar risk? Divide that by your stop loss amount. What's your maximum dollar gain? How many shares do you have? How far will it move? What's the potential gain? This is all very simple, but I thought it would be good to just give you the calculations here because we're going to be doing a lot of that. Your reward to risk. Your dollar gain divided by your dollar risk. And your target gain, simply your entry minus your targeted shares times your shares. So here is an example of how you could decide your risk based on your account size. And we're saying here's a $100,000 account. We're going to risk 1.2% of capital on any given day. And we're going to take a max loss per trade of $300, which will allow us 4 trades per day. If you have 4 losing trades, well, you're done for the day. No more trading. Turn it off. And it's not that you have to turn off the computer, but you certainly have to turn off your ability to place live trades. Of course, you can go into paper trading mode. And if you do that, you need to approach that paper trading as if it's real trading. Don't press the button unless it's something that you would really do it. And the other side, if things are going well as you're paper trading, is it because of the lack of emotion connected to it? That's something that needs to be considered. And you shouldn't feel bad that you turned off the live trading, because that is just part of your rules, and this is part of the discipline of following the rules. So here, you can see one of our calculations in this simple, where your stops are and your maximum share size, where I've got a $300 risk, and if my stop is 40 cents, I can trade 750 shares. That would be my share size to execute the trade. We're going to determine risk based on the chart. There are methods which would say that, well, I'm only going to risk X amount of dollars per trade, and at least that's a starting point. But some of these methods do not take into consideration the technicals, which for me, I approach the market, it's kind of like just a shot in the dark, whether you'll get lucky or not. They may say, well, prices have pulled back. Maybe they're a Fibonacci type of trader, and it's pulled back 50% from the prior move. So I'm just going to enter there and with a predefined money stop and see what happens. That can work, but that's not our approach. We're going to have predefined setups based on our technical concepts. And that's how we're going to enter and where we're going to put our stop. I'm using $300 risk. Now, at what point are you going to put your stop? Where is that going to be? On this slide here, I'm showing different levels of where your stop would be and the size of that stop. And you can see as it gets further away, we're reducing the amount of shares. Now you may look at this and say, well, Greg, this looks great. I can get 2,000 shares, and if it goes to my target, I'm going to make X amount of dollars more than if I take the 30-cent stop with 1,000 shares. I would say, well, that's absolutely true. It's black and white. That's the math. Of course, that's assuming the setup works out as planned. Sometimes, for whatever reason, you may decide that this setup looks good, But there are certain things, if you will, that have created a bit of uncertainty about this actually working out with a tight stop. I like the pattern. I like the trend, different concepts that are all coming together. They all make sense to me, and I'm going to place that trade. However, as I said, for whatever the reason might be, I feel I'm going to give this a bit more room. And to do that is all well and good, and we're going to look at this in different ways of how to utilize that and take advantage of it. And then if I give it that amount of room, of course, if it goes down there, I'm still losing the same amount of money. It's the same $300 risk regardless of where the stop is. It's less shares, of course, but I'm still risking the same $300 at each point. Target considerations. A larger target requires a less restrictive management to achieve that. As it says, you can't hit a $3 target with a 10-cent trailing stop on a 1-minute chart. That is ridiculous. It's just not going to happen unless you get extremely lucky, and we're not looking to get lucky. We're looking to be consistent in what we're doing. You can't hit these big targets without living through some retracements. It is what it is. If you're holding a swing, or actually probably a core type of position, and prices are even accelerating to the upside, and you've got a good profit, and that type of a move strongly suggests that prices are going to pull back, yet you don't want to give up the shares because you believe it's going to go even higher, but the evidence is such that it's very likely to pull back. So selling covered calls at that time. You're going to sell a call option above recent prices because you believe that prices are not going to go there. And as the stock declines from that point, as the price suggests, those call options will lose value or possibly even become worthless, which reduces your cost. You get to keep that money for that option that you sold. It's a great strategy. It lowers your cost. And many that hold long-term positions in a stock that does continue to go up over the long term can continue to generate income by selling those covered calls. Intended duration in the time frame. Well, the management starts in the time frame that you're trading in. You cannot hit a swing target trailing bar by bar, and I'll explain what bar by bar is, but you can't hit that target on a 5-minute time frame. Can't tell you that I avoided that mistake in the early days, because I was trying to tighten the stop up. I was trying to, of course, keep the gain that I had and then move to a small intraday time frame to manage it, and would get stopped out only to see the stock move in the direction suggested by the higher time frame. Doing a swing trade, if you're going to move to smaller time frames at a certain time, use the hourly time frame. As you condense that data, you are by definition seeing fewer corrections, and that's exactly the goal, what you want, not to be influenced by minor movements against the bigger time frame. Personality traits. It says some traders can't give back a dime. They're just nervous traders. So you have to know who you are as a trader. And there are certain things that may not be avoidable, meaning that's just who you are. And accept that. You're going to manage in a tight way. Hopefully you have a high batting average, meaning you're right a lot more times than you're wrong, because your winners are not large, but you're trading consistently with the method and plan that you were using, so you make money. It's okay. I've worked with traders that admittedly are nervous traders, and they make very good money because their plan revolves around how they are. Some traders do not know why you would ever sell anything. I'm not one of those, but they want to hold on, and I know people that have held Johnson & Johnson for many years and have made a very large amount of money by doing that, but they've sat through some horrendous corrections as well. So this considerations must be given to the work with the personality at hand. So trade intention and the time frame reality. Smaller time frame, the more data, the more pivots, the more shakeouts, etc. So as explained, you can't go down to those smaller time frames because those things, pivots, shakeouts, and such, they're going to happen on those smaller time frames, but they're not meaningful in a higher time frame. So there's some guidelines. As a core trader, you manage from the weekly charts and zoom to the daily. As a swing trader, you manage from the daily and you go to the hourly. Most of the day, manage on the 15-minute, and you can go down to the 5. A morning trader, gap trader, holding into lunch, 5-minute charts, stay on the 5-minute chart. And if you're a scalper, you can manage from the 2-minute. You may go down to the 1-minute. I don't suggest going to the 1-minute because unless there is strong momentum moving in one direction, the 1-minute will certainly stop you out. All right, let's move on to part 2.